Hello and welcome to the first Elliot Wave Insights of 2015. Today Brian joins us down the line to discuss the aftermath of the Swiss National Bank's actions on January 15th. Brian, you say the uncle point is when central banks have to cry for mercy. But what led the SNB to choose the moment it did to abandon the peg? And what has to happen before this domino effect of central bank action will end?
Right, well, our view is that the SNB didn't choose anything. The market chose for them. Millions of currency traders applied pressure, and on January 15th, the SNB cried uncle. They said, enough is enough. We cannot defend this 120 exchange rate because if we do, we will destroy our balance sheet. Now, about the domino effect you mentioned, it will only end when credit has been fully deflated, when debt levels are a fraction of what they are today. Unfortunately, history tells us that central banks will fight this process of credit deflation every step of the way. The SNB, for example, is now defending a level of 110 francs per euro. The Danish central bank spent 100 billion in January to keep the kroner from rising. That's a record. Sweden will soon take interest rates negative. Poland and the Czech Republic are also preparing to cut interest rates. Central banks are competing with each other. In the process, the entire continent is tipping into deflation, and our analysis says it will only intensify.
The common consensus is the formerly safe Swiss economy will bear the brunt of its central bank decision. Do you agree with this, Brian?
Yes and no. Near term, yes, Swiss exporters will get hurt. Most blue chip Swiss companies, watchmakers like Swatch, pharmaceutical firms like Novartis and Roche, they sell most of their goods outside the country. So their profits are getting hit by the strong franc. We've seen some profit warnings, some dividend adjustments. Also, the Swiss PMI just fell in its sharpest decline since the financial crisis. So that gives us a snapshot into the weak position of Swiss manufacturers. Longer term, however, I think that the SNB panicked early and they got out in front of a bigger panic to come. I think that the markets will eventually force the ECB and force the Fed to abandon their own efforts to fight deflation. The ECB just launched the €1 trillion QE program, but I think that political pressure will eventually force them to terminate QE. Either way, deflation is winning, and the sooner central banks get out of the market's way, the better off we'll all be.
The Swiss franc may have overshadowed the euro in January, but the single currency is down some 80%. What do you make of the euro-dollar parity discussion?
Yeah, the euro has bounced a bit from its lows 2 weeks ago against the dollar. Near term, we expect that rally to continue for two reasons. For one, we can label a complete five-wave decline from the euro's peak last year. In Elliot Wave analysis, that structure implies a bigger bounce than what we've seen so far. More important, however, sentiment toward the euro has gotten downright abysmal. Futures traders have been lopsidedly bearish for months. As you mentioned, lots of analysts have suddenly come out to forecast dollar parity. I think that the euro will eventually reach parity with the dollar, but this sudden outbreak of negative sentiment toward the euro, when we combine that with the Elliott Wave structure, it argues that a larger upward correction will occur first.
Brian, thank you. Well, viewers, tune in again next month for the next EWI Insights, but from Brian and myself, it's goodbye for now.